Welcome to the Nifty 50 Derivatives Intelligence Report for the June 9, 2026 expiry. What is Nifty 50? The Nifty 50 is India's most important stock market index. It tracks the top 50 companies listed on the NSE, National Stock Exchange. Think of it like a barometer for the Indian economy. What are derivatives? Derivatives are financial contracts whose value is derived from an underlying asset, in this case, the Nifty 50 index. The two main types we cover here are futures, an agreement to buy or sell the index at a fixed price on a future date. Options, a contract giving the right, but not obligation, to buy, call, or sell, put, the index at a specific price. Key terms on this slide. Expiry date, June 9. This is when all the derivative contracts for this cycle expire. After this date, they become worthless. Data as of June 2. The analysis uses data captured at 3:30 p.m. on June 2, that's 7 days before expiry. TTE, time to expiry 7 days remaining until these contracts expire. Sentiment score -3, cautious or neutral. This is a scale that measures overall market mood. A negative score means the market is slightly cautious, not a strong bull or bear signal, but leaning defensive. This report is for professional use only and is not investment advice. Always consult a registered advisor before trading. This slide gives you the big picture, where the market stands right now. Spot price, 23,483. This is the actual live price of Nifty 50 in the cash stock as market. If you bought all 50 Nifty stocks in proportion right now, this is what the index would read. Nifty future, 23,589. The futures contract is trading at 23,589, that's 106 points higher than the spot price. This difference is called the basis or premium. Why does a futures premium exist? Normally, futures trade slightly above spot because buyers factor in cost of carry, interest, cost of holding a position for 7 days. A healthy positive premium means institutions are comfortable holding long, buy positions. Sentiment score -3, cautious neutral. Despite the bullish premium, the overall reading is mildly cautious. This is because the options chain, seen in the heat map, shows heavy call option selling near 23,500 to 24,000. This overhead supply acts like a ceiling on price. The 23,500 level is described as the critical battleground. If Nifty stays above it, bulls are in control. If it falls below, bears take over. Always watch what happens around this level at market open each day. This slide identifies the 3 most important price levels. Think of them as the lines in the sand that institutional traders are watching closely. What is open interest, OI? OI is the total number of outstanding, open, derivative contracts. High OI at a price level means a lot of traders have placed bets at that level, making it a magnet for price action. Key resistance, 24,000, the liquidity trap. Call OI of 5.7 million contracts here means many traders have sold call options at 24,000, betting Nifty won't go above 24,000. If Nifty starts rising toward 24,000, these option sellers, market makers, must buy the actual index to hedge. This is called delta hedging. This buying accelerates the rally. So 24,000 is both a ceiling and a potential rocket fuel level if breached. Magnetic pivot, 23,500, center of gravity. PCR, put-call ratio, is balanced here, meaning equal bullish and bearish bets. Spot and futures are converging near this level. Like a magnet, prices tend to keep getting pulled back here. Watch the first 15 to 30 minutes of trading to see which side 23,500 breaks toward. This sets the day's trend. Critical support, 23,300, institutional defense zone. Put OI of 5.0 million contracts here means big institutions have bought put options to protect themselves below 23,300. If Nifty breaks below 23,300 with sustained selling, those protective puts trigger stop losses in bulk, causing a sharp, fast drop. This is called cascading stop losses. Summary: trade between 23,300 and 24,000 is a range, respect the extremes. This slide tells you exactly what to do and watch for, depending on which direction the market moves. Think of it as your decision tree. Bullish scenario: what signals a market rally? Trigger: Nifty future sustains above 23,700. Not just a brief spike, it must close and hold there. Confirmation number 1: volume in Nifty futures increases, big players are actively buying. Confirmation number 2: call OI at 23,500 and 23,600 decreases, option sellers are buying back their shorts, covering, which removes the ceiling. Confirmation number 3: the basis, future minus spot, expands beyond 106 points, institutions are adding fresh long positions, a bullish sign. Mechanism: when market makers cover their short calls, they're forced to buy the underlying index, which pushes price rapidly toward 24,000. Target: 24,000. Bearish scenario: what signals a market decline? Trigger: a sustained close below 23,300. One candle dipping below doesn't count, price needs to stay below. Confirmation number 1: put OI at 23,300 spikes, means institutional players are adding protective puts, a defensive move. Confirmation number 2: basis collapses below 50 points, institutions are reducing their long exposure, bullish carry is being abandoned. Confirmation number 3: long unwinding detected, funds that were holding long positions start exiting. Mechanism: stop losses cascade in a chain reaction, accelerating the fall. Target: 23,000 to 23,100. Key lesson: never trade the direction based on hope. Wait for all 3 confirmation signals before entering a trade. This is the most practical slide. It tells you what to watch, how to manage risk, and gives you a quick reference table. The basis monitor: why watch the 106-point premium? The basis, futures price minus spot price, is like the market's pulse. Institutional traders' intentions are hidden in this number. Expanding premium, basis growing, big players are adding long positions overnight or pre-market. This is a healthy bullish signal, hold or initiate long trades. Collapsing below 50 points, basis shrinking fast, this is a red flag. Large institutions are booking profits or reducing exposure. A rapidly falling basis often precedes a sharp correction. Exit or hedge your longs. Risk management: 3 rules for the 7-day window. 1. Avoid deep OTM options. OTM, out of the money, options equals strike prices far from current market price. With only 7 days left, these options lose value very fast due to theta decay, time erosion. Even if the market moves your way, the time decay can eat your profits. 2. Size positions carefully near 23,500. The market is prone to whipsaws, sharp moves up and down, around this pivot. Don't put your full capital on one bet near this level. 3. Wait for basis to signal. Don't make aggressive directional bets, pure calls or puts, until the basis clearly shows institutional intent. Expanding equals bullish, collapsing equals bearish. Quick reference table. 24,000 resistance, our breakout target. 23,500 pivots, watch opening bias. 23,300 support, the danger zone if breached. This final slide is the most important one to internalize, especially for beginners. What this report is, and isn't. This analysis is built on quantitative data, open interest, futures basis, and derivatives positioning. It identifies probabilistic zones, levels where the market is more likely to react. But the market can always surprise you. These are not guaranteed price targets. Think of them as road signs, not guarantees. The 4 golden rules summarized. 1. Align with your risk appetite. If you're a conservative trader, these setups may not be for you at all. Aggressive traders might use wider stop losses, conservative ones might skip the trade entirely if risk-reward doesn't fit. 2. Define your stop loss first. Before entering a NY trade, know your exit point for a loss. For example, if you buy expecting a breakout above 23,700, your stop loss might be at 23,500. If you don't define this in advance, emotions take over. 3. Beware of theta decay. 7-day TT options lose a portion of their value every single day, even if the market doesn't move. With just 7 days left, this decay accelerates sharply. Buying FAR OTM options here is extremely risky. The time value bleeds out rapidly. 4. Monitor the basis. The future minus spot premium is your real-time dashboard of institutional behavior. A healthy, expanding basis equals confidence. A collapsing basis equals caution. Final thought for beginners: the derivatives market is powerful but complex. Use this report to learn the mechanics first, paper trade, practice without real money, to build confidence, and only risk capital you can afford to lose. The market rewards patience and discipline above all else.